In other business news, Nedbank's latest report reflects that the banking sector is starting to show signs of recovery. That's as the entity has reported an 8% rise in headline earnings due to fewer impairment charges amid muted income growth and poor loan growth. Meanwhile, household credit growth dropped by 3% as consumers are still highly indebted, with many spending more than 60% of their income on debt repayment. At the same time, business credit growth has accelerated by 5.4%. Staying volatile and not reflecting increases in fixed investment activities. The bank says it expects an improved economic climate in 2025 with the anticipation of further interest rate easing. Nedbank CEO Jason Quinn joins us for this discussion now. Thank you so much for your time, Jason. GDP is up slightly. What's the projection from Nedbank on the near-term outlook of improving economic growth that, of course, is likely to benefit the business?
Tumisang, thank you, and great to be with you and your viewers here this evening. Look, last year, 2024 was a tough year by all accounts. If you just think through the year, started off really slowly. A lot of people sitting on the sidelines, whether they were consumers or corporates in the lead up to the election. And then, swift, free and fair elections, formation of government of national unity, saw some buoyancy in financial markets, some cautious optimism emerge more towards the end of the year. But then we only started to see the rates come down. We always thought it would be a shallow rate cutting cycle. In other words, we wouldn't see rates come down a lot, and that is what's playing out. Like from here on out, we've had three 25 basis point cuts. We might only get another one if you think about what's going on in those metrics. But we remain cautiously optimistic, Tumisang. I think that even in this year, it's likely to start off a bit slower and moving towards the end of the year with growth picking up a bit more. There's a couple of real factors behind that. There's base effects, of course, with energy issues in the prior period and less energy issues today. But we always remain cautious. If growth does pick up, more than what we think, which is always possible, energy kind of constraints could reemerge. So there's many variables at play here, but it certainly feels like 25 should be better than 24. And as you say, that will also be good for Nedbank.
Having said that, Jason, the gains that you're looking to make in this brand new year with the dynamics at play, and of course, we know on the global scale, the world economy is facing geopolitical tensions too.
Yeah, we do call that out as one of the risk factors towards our guidance, the macro guidance, and that would impact all companies in the market. So, so many elections contested last year. We're dealing with fallout, I think, in global trade, as a consequence of the US issuing tariffs and the like. Now, South Africa, as you know, faces Europe extensively with respect to trade, France, Germany, the UK. We are pointing more and more towards China, which is, of course, a nice diversifier. But there is still trade with the US. And to the extent tariffs emerge there, that would be a risk for us. It would be a risk for various sectors, including agriculture and motor sectors in particular, I think. But also at the same time as that, you've got pretty weak macros in Germany, France, and the UK. So certainly being here in South Africa at the moment feels like we've got more things in our hands, under control, and things that we can kind of be a little bit more optimistic about. But I would call out, geopolitics globally still as a risk.
As a parting shot, Jason, we understand that Nedbank will be undergoing a restructuring. The concern, though, is around jobs. Are employees safe?
Absolutely. Tumisang, what we know, so Nedbank is, as you saw, a growing company with growing earnings. We also, value our role in society deeply. And whatever happens here around Nedbank is really to more organize ourselves to serve our customers better and to focus on our customer segmentation. In fact, to grow our revenues and build scale. So I've said today a number of times that, this isn't a cost-cutting exercise. This is, in fact, positioning us in client segmentation. And if we find any cost savings, then we're going to reinvest those in the front line. And if there's any jobs at all impacted through this, we'll seek to redeploy those colleagues. So this is not a job-cutting exercise. This is a strategic repositioning in a company that is growing to kind of fulfill our potential.
Thank you once again for your contribution. Jason Quinn is the CEO at Nedbank.